Belmont, by the way, is defining this as net sales. It's because this is a company that has what's known as chargebacks. Chargebacks. And chargebacks is a phenomenon in some industries wherein someone sells something, or the business sells something, the consumer says, I don't like it, and returns it. And the way that this company accounts for that is what they call a net sale. That is, it's gross sale minus the chargeback equals net sale. So they call it net sales. It's got a chargeback associated with it. A lot of companies use chargebacks, and they account for it by way of calling it net sale. Imply there's a chargeback associated with it. But here, we know the revenue here is this net sale. And the net sale in this is $12,800. We should have denoted, therefore, revenue and net sales as $12,800. One more time on the net sales, that will be important to you. Look at an income statement, and the bookkeeper, CPA firm, or whoever's done it, denotes the net sales. It means the company earned X in revenue, consumers returned the product, charged back the product, the company, the bookkeeper, then adjusted the revenue down to what they call net sales, the actual amount of revenue that came into the business, minus the chargeback. You should be cognizant of that fact. So when an income statement comes your way and you see net sales, not revenue, you know the company has got issues with chargeback. Now, what would that tell you right off the bat? Companies have issues with chargebacks. Large chargeback ratio to revenue. What would that tell you? What does that give you an insight to that might right off the bat be a clue?
Inferior quality.
That's right, quality issue. We call that total quality management, TQM. We'll talk about TQM, and this could be a TQM issue, it could be a quality management issue. No question about that. So when we see net sales demarcated on income statements, particularly, one of the clues we have as consultants in the consultant industry is we recognize that we might be dealing with a company that's got quality issues. Belmont might have that issues. Cost of goods sold, again, are what it takes, the materials to produce the furniture, to sell the furniture. And we're using Belmont Furniture Company, for example. This whiteboard gives, or this white screen gives you the ability right off the bat to see what the cost of goods sold are. Your task for homework this week, however, your task for homework this week for the project you got this week, very easy, is how do you calculate that? I'm going to show you how to do that, and how to do one of these, and I'm showing you how to do this right now. It's your homework for the week, how to do this, and how to calculate cost of goods sold. Okay, easy homework for the week, easy homework for the week. But cost of goods sold here has already been calculated for you, and that makes the calculation pretty easy, because we see that at $5,750. So $5,750 we subtract out in order to get our gross profit and our gross margin. When you do the math there, what does that come out to be? You guys are the mathematicians, what is it? What's the number?
6,300.
6,300, does that make sense? No. $7,050, does that make sense?
Yes.
Okay. Just gotta watch your math here.
Well, I may have done the wrong numbers.
Okay. So, when someone says, what's your gross profit or gross margin, you should know, you should be thinking tonight, my gross margin, my gross profit, is a function of revenue less cost of goods sold, or cost of service sold, right? Business people who are talking the lingo of business, especially if they're in the same industry, will often ask you, well, what is your gross profit? What is your gross margin? Again, back to the Shark Tank. One of the big questions they ask the entrepreneur when he or she comes up front, makes their presentations, the investors want to know very quickly, what's your gross profit, what's your gross margin? They're after, more specifically, profit margin. And I told you profit margin is not the same thing as gross margin and gross profit. We'll show you that later. But they'll ask that question, what's your profit margin? They expect the entrepreneur to know what their gross margin, what your gross profit is, and or what your profit margin is. I anticipate and expect you to know that, so when you talk to the people who run businesses, you're talking intelligently. And it would be very interesting, by the way, that if you could convert this to a percentage, that is, you take this and divide it by that, we call that vertical analysis. I'm going to talk about that tonight. But if you could take this and divide it by that, or this and divide it by that, and come up with a percentage along here, then you could start talking about, well, my gross profit is roughly 50% of my revenue. And an investor or somebody who's cognizant of your industry might say, whoa, wait a minute, gross profit 50% or 40% in this case, for example, that's a little off compared to industry norms or benchmarks you've got a problem with either revenue or cost of goods sold. Right off the bat. That make sense? So if I know that this number, this divided by that, is gonna give me roughly 30–40% right in that neck of the woods, but this kind of company should be doing something in the neighborhood of 50%, red flag. And that red flag that's coming to me as a consultant is either something wrong here or something wrong there, because the industry norm, the benchmark, the peer comparison's telling me that the margin this company has is off. That's helpful. That's helpful. Absent the peer comparison, absent the benchmark, you're in la-la land. You can't consult somebody. You know, they tell you this is it right here and this is what my margin is. This divided by that, you as consultants say, well, hallelujah, you're doing a great job. No, you can't stop there. Business people, as consultants, as people who are running businesses, you want a peer comparison. You want to ask yourself, how well are they doing relative to the rest of the industry? Yes? How well is this to the rest of the industry? How well is that to the rest of the industry? And so on and so forth. That's vertical analysis. Chapter 14, we'll talk about that. Why that's important, okay? You ought to have competency of this. All of you should have competency of this and understanding not only the elements of an income statement, but these peer comparisons or these benchmarks and why those are important. So when you're sitting down and consulting with somebody and you're breaking the numbers down, you're looking at an income statement, you're doing the math, or you're doing the division to do a ratio analysis, and you look at it right off the bat, you should be asking, what's the peer? What's the peer? What's the peer? What's the peer? So now when you start looking at the peer and you compare the actual, you can talk intelligently to the business person. You can say the peer industry is telling us X, but you're at Y. Why? Right? Why? And you as business students will tell them it's likely because you've either got a revenue problem or a cost of goods problem. In managerial economics, we would say you either have a maximization issue or a minimization issue. Therefore, the objective function is to either maximize or minimize. There you go. You just integrated theories you learned in the last class in the presentation. High point value. High point value. Okay. All right. So now we have to move from gross profit to gross margin into subtracting the electricity, the labor costs, and all the other costs associated with running the business, except for usually what 2 or 3 expenses that business people don't typically denote in operating expenses. What are they? Taxes, interest, and depreciation, usually. Usually, not always, but usually. Mostly interest and taxes. EV, earnings before interest and taxes. Well, in light of that fact, when we move back up here, we start crossing off the ones we've used, it leaves us other expenses here, and we see general and administrative expenses. Does that look like an account that could account for the general expenses, including lights and anything else associated with running business? What do you think?
Yes.
Yes, it can. In point of fact, it can. We might call those general admin expenses. And those general admin expenses are how much? 8,000 what?
850.
850, all right, $850. Do we see any other expenses that might fit up there? What do you think?
Building and equipment. What is building and equipment doing?
Let's talk about that. It's a great question.
So that's like cost of.
Well, hold on, let's talk about that. Let's answer that question by asking a question. Is building equipment more likely an asset or an expense associated with running the business? Therefore, if it's an asset, is it likely to be on this side of the board or on this side of the board?
On the balance sheet.
It's on the balance sheet. So when you think of anything in a business that can be liquidated, usually, and converted to cash, it usually fits on the asset side. So that therefore would not be an income statement.
But is a
Phenomenal.
building only liquidation for
liquidable.
Liquidable. Can be liquidable, it can be,
Is if you own it,
can still be liquidable,
even if you're renting?
even if you're renting. No, if you're not renting and you don't own it, no. No, then that would be a little bit different, that would be booked as an expense and not as an asset.
Okay.
Good question
So
to
how do we
delineate.
know whether they own it or?
We don't here. We don't know whether they own it or not, but the building equipment for now, at least it's framed in this without being over analytical in this, it is clearly an asset that fits on that asset side. Now, if we had a little asterisk right there that denoted down here what this means, that might be a little bit different. But for tonight, for academic purposes, this is clearly an asset side equation. All right, so when we subtract the general admin, and let's say this business is a business that in fact puts into its admin or into its expenses depreciation expense. We could add depreciation expense up here before we get to operating income. Let's do it. Let's just say this is a business that in fact takes its depreciation expense and adds it in here as an expense. And since this is something I want to demonstrate tonight, what is the admin expense? What's the number? $500. That is the amount of money that the company is depreciating largely off the equipment they bought up here. They're expensing $500 off relative to the depreciation, be it straight line or accelerated or a variety of other kinds of means of depreciating. And for the year, they've calculated that $500 represents the depreciation expense. And so, in light of that fact, then we would come down to what we call operating income.
Or I don't,
Go ahead.
why wouldn't you do accumulated
Depreciation. It's a good one, isn't it? Why isn't accumulated depreciation a phenomenon of the income statement? Think about that. Yes?
It's total over time for your depreciation, isn't
Yes, it is, and therefore, is it an asset or a liability?
it?
Or is it cash? We'll come to that, so hold your thought on that. Good question, though, good question. It's not. Accumulated depreciation isn't something we accumulate on the income statement. To the contrary, we accumulate it on the balance sheet, yes.
Why wouldn't inventory, I mean, I can see it being an asset, yes, but why wouldn't it be an operating expense as well?
All right, so you got this inventory sitting in your building there, right? And to use for the purpose of generating whatever product or service you're trying to do. It isn't really doing anything for you until you pick it up and use it, build it, and make something. We've already booked that. Where did we book that at? Cost of goods sold, didn't
Yeah.
we? Otherwise, if we are in trouble, the Great Recession #2 hits us, right?
Right,
And we need to liquidate because our industry got hit hard. We're in the building industry, 2008, 2009.
and we have that sitting.
We have that there. What kind of thing is that?
That's an asset.
That's exactly right.
Okay.
And that is why I framed it the way I have. It's a very good question, but it's why I framed it, because we as business owners often frame what we have around us in the event of an emergency. What is fungible? We call that fungibility. What is fungible? Liquidable in case of a
Or we
issue.
turn into money right away.
Or we can borrow against if we need to go to the bank, right? And we need to demonstrate capacity to be able to borrow. Then that's sitting there, if it's valued enough and not completely depreciated or not outdated. Moore's Law, for example, in the tech industry suggests anything that's a year and 6 months of age is outdated. But if we're in an industry where that doesn't happen and we can inventory that clearly is not an expense. It becomes an expense when we use it, but we book it as a cost of goods sold, not as an administrative expense. Good question, Joe.
Can you claim it on both sides?
There's what we call a contra account. We'll talk about what contra accounts are, where you have that phenomenon, and you do have that phenomenon in depreciation, where you have the depreciation expense on the one side and the accumulation expense on the other, but not the same, not the same. Same phenomena, a little different, contra account. We'll talk about that a little bit later. So what is our operating income when we subtract this from that?
5,700.
5,700, but we call that earnings before what? Earnings before what? Interest and taxes. Does that make sense? Okay. Do we have an interest expense up here? what is the interest expense? How much is it? 900?
Yeah.
900, and do we have a tax expense up there?
$1,440.
How much is the tax?
1,440.
1,440?
Yeah.
1,440, and it gives us a net income of how much?
$3,360.
3,000 what?
360.
There you go. Bottom line, net income. Bottom line. So this depreciation expense, and even sometimes interest expense, can be an issue because of what we call a contra phenomena. That is that both of them can be denoted on both sides, even though there will be different numbers. Let's do this now. The asset we saw on the left side are defined as either current assets or long-term assets. And current assets are assets that are less than a year, and long-term assets are assets that are held longer than a year. So we need to break them down between current and long-term. So we would call it current assets. Let's define current assets relative to fungibility. What did I tell you fungibility is? Liquidable. What's the most fungible asset we have up there? Cash, we do, don't we? Would you agree with that? It doesn't get much more fungible than that, right? So, one of our current assets that we could quickly get at within a year, if we needed to, current assets within a year context, would be our accounts receivable. What do you think the second most fungible asset a company has to get their hands on if they get in trouble? What do you think?
What is $300?
Okay, let's stop. Who says stocks and bonds? Why would stocks and bonds, in your argument, be a very fungible asset?
You can just cash them out.
Cash amount? Well, if you have a publicly held company, that's correct. But if you're closely held and very small and your company's in trouble, who's going to buy your stock? Right?
What's the 300?
Yeah,
Should be
Is it what's the total asset? Total cash?
16,550.
I thought somebody said 300. I'm sorry. So cash is what?
16,550.
550. Good question. Thank you. Okay. Depending upon you, tell me. So that's cash. That's cash. The question was, what's the second most fungible asset? The answer for some of you was stock, but if you're in trouble or you're a closely held company, privately held, mom and dad, who is going to buy your stock?
Accounts receivable?
Why would AR be the second most fungible? Argue why you think that's the case.
Because you're just collecting a debt.
Yeah, you're collecting something that somebody owes you. And if this company is a company that has an AR ratio where it's taking them 120 days to collect, which is not unusual in the medical community, by the way, so 6 months or longer, and they've got a cash flow issue, we could certainly solve the problem by getting that AR down from 120 days down to 90 days or 30 days, for example. But we're running a business and we've got to get a hold of some cash. Getting on the phone and telling people who either owe us money, or getting Guido out there to beat them up, to get the money, whatever, is a method by which we can get our hands on cash pretty quickly, and therefore you're right, AR is the second most fungible asset we have in the business. And so what is AR, how much is that?
9,600.
Accounts receivable,
9,600.
You're looking at payroll.
9,600?
Yes.
Yep.
9,600, we agree with that, AR, accounts receivable, right? Running a business, think of fungibility. Inventory, that's right. Inventory would be the third most fungible asset. We got to get rid of that inventory sitting over here, right? We got to sell that. If we can fire sell the inventory, we can sell it to a competitor. You know, a competitor who's beating us out in the marketplace. They'll take our inventory, right? That's right, they will. Now, you're in the cabinet industry or the woodworking business, you know exactly what I'm talking about, right? You got all this wood inventory sitting over here and you got some trouble. Guy down the street who does the same thing you do, pick up your inventory for 50 cents, 60 cents, 70 cents on the dollar, kind of thing.
Indeed.
Yeah. So inventory, how much do we have in inventory? $6,500 in inventory. All of these are a function of short-term or current assets. Defined is something we're likely to be able to do within 12 months. Is it reasonable that within 12 months we could pull cash out of our business? Of course it is. Is it reasonable that within 12 months we can shore up our accounts receivable issue? Of course we can. And is it reasonable that that within 12 months we're likely to get at our inventory control, liquidate some of our inventory? What do you think? Yeah, totally. You see anything else up there that's current?
Accounts payable.
Okay, so
Retained earnings, what's that?
and we'll come to that. Good question on that retained earnings. It'll be part of the education you're going to get tonight. Why isn't building and equipment within a year?
Because you generally depreciate them over multiple.
Long
years.
time frame, and therefore it doesn't fit within the 1 year liquid pull out type constraint. And to the contrary, it's a very long term type of gig. If you got a business, you're gonna amortize it. You're mortgaging it for a long time. If you bought a building, for example. Building and equipment then would be defined, since it's not fungible usually within a year, it would be defined as long-term asset. Does that make sense? So we'll call that, so long-term here, long-term assets. And long-term assets, we have sitting in here, building and equipment. And how much is that building and equipment?
122,000.
122,000? We got a problem with that valuation, don't we, on a balance sheet? If we bought this business, we bought this building and equipment 5 years ago, would it be right to denote it on a balance sheet as the actual market value? What's wrong with it? It's been what?
What you paid for it.
It's been depreciated, hasn't it? And we have to somewhere account for that. We have to somewhere balance that phenomena. We have to show people a true valuation relative to accumulated depreciation. Now, don't confuse that with actual market value. You could have depreciated something over a long time frame and it still can have great market value. But on a balance sheet, we still have to account for it in terms of numbers. We have to offset this so we accurately get at a fair number under the IRS code for valuation. So what do we do? How do we do that? What do you think we do to get this number more accurate?
Then if the depreciated less.
We gotta offset this by the accumulated depreciation. What is our accumulated depreciation?
34,000.
34,000, so we put the 34,000 here, but we do that in brackets. What we call a contra account, accumulated depreciation. What we're doing is we're subtracting this from that to show what's been depreciated, to give a real value of our building and equipment. That make sense?
What about retained earnings?
We'll come to the retained earnings criteria. Hold on for a second, we need to define what that is. Retained earnings is a phenomena that's a little bit unique. What else is missing up here that we haven't used?
Long-term debt.
Debt, does that fit on the asset side or the liability side, do you think?
Liability.
Liability, we're working on assets right now. Good question. What else? Anything else that fits on the asset side that we haven't used either here or there?
Stock.
Common stock, retained
Stock.
earnings.
Is that something that shareholders might have a value to?
Yes.
So that might fit in the black zone over here, yes? What else?
What's notes payable?
Notes payable. What do you think notes payable is? We owe people money on that. Is that a liability that we can put under the asset side of the equation, or is that an asset? Liability, notes payable, liability. Anything else you think? Or you think we're good to go to calculate what our bottom line is?
Interest expenses?
Did we calculate for interest expense?
Is that,
Down here, we calculate our interest expense down here. That's an ongoing
oh,
expense
okay, so.
on the income statement. So that's, we're talking about on the assets. Remember fungibility, things that we can either liquidate within a year or give us value longer than a year. Do you think that we've captured it all? What's our bottom line when we do the math down here? 16 plus 9 plus 6 plus 122 minus 34. What do we get? $126.50. And somebody want to check that?
That's right.
Yep.
120,650. Does that ring true? 120,650. $120,650 on the asset. That means, what do we have to have on this side collectively?
We saw 120,000.
Same exact amount, don't we? Now, what students learning this do first is the shareholders' equity and then the liabilities next. Because the shareholders' equity is quite easy. You've already identified, and someone's asked me 2 times, what retained earnings is. What is retained earnings in business? Retained earnings is the amount of money that you designate for usually dividend payouts. This company, we don't know whether they're going to use this for dividend payout. And if it's a dividend payout, who do we usually pay dividends to? Shareholders. Therefore, if it's a dividend and it's for shareholders, it fits under shareholders' equity, right? So, retained earnings is a phenomena of shareholders' equity. Why? Because retained earnings are used to pay whom? Shareholders. That's exactly right. Usually when you see retained earnings on your balance sheet, and you will, and the balance sheets you look at, it's usually money set aside to pay the owner. Okay? The owner. Or in this case, shareholders. So retained earnings, how much did we have in retained earnings sitting over here?
15,250.
15,250? So $15,250, and what we call retained earnings.
See that guy this one?
What else do we have under shareholders' equity? Stock, right? How much do we have in stock? 45,000. All right, so 45,000, and that'll be it. So when we total that, what do we got over here? When we add that together, 15,250? $60,250. Therefore, by extrapolation, this minus that will equal that, right? We'll test that when we get back. Let's take our break and come back at 7:25, okay?
This is working out great. I'm so tired of editing film. So we just bought this over the weekend. I'm like, I wonder if I can just stream it. I bought a new phone and I'm just streaming it live, so I don't have to edit it or anything. I just didn't know where with this camera I needed to be in the room. Sounds pretty good too. So, and I can read everything, which is actually I hope I can. Let's find out.
You're interested in working together again?
I guess.
I have an appointment or a connection with the CFO of Music.
Oh, nice.
Are you interested?
Yeah, sounds great. And
Then I'll make that connection and try to
Okay.
set up the appointment probably for next week.
sounds like a plan. Sounds like a plan.
That is free.
It looks
What are you
clean
streaming
too.
it through? Just YouTube? It looks really good.
Yeah, it looks good. I'm streaming it straight to YouTube. I'm using a third-party app that YouTube suggested. I mean, it was free, which is great.
Good grief, you know so much more about this stuff than I do.
I just Googled it. I'll be honest. I was like, this editing is getting, like, because I was spending like 5 to 7 hours every week just trying to get it online. Because it wasn't, because then I'd have upload issues, I'd have to start it over again, and the whole house's internet crashes while I do it. So I'm like, all right, let's see if I can be more intelligent than this.
How'd the test go for you?
Went pretty well.
Tough.
Yeah, it was. There's one specifically. I'm like, I don't know that we. I don't remember.
I feel like we did. I feel like I went over everything, but it's like to understand it all, like answering some of the word questions.
Yeah.
It's like, wait a second, hold on.
Yeah, exactly. It's like,
Going back,